Sometimes the footage mismatches the vibe, like we're trying to explain market swings with a side of crypto memes. We're amateurs here, fumbling through free assets and DIY edits, but trust me, the info we're dropping on stock market volatility is legit useful, no cap. So hang tight, it gets better from here. And quick heads up, this is not financial advice at all, just some educational entertainment to break things down simply. Do your own homework, talk to a qualified advisor, and never bet the farm based on a YouTube script. Ever wonder why your favorite stock app lights up like a fireworks show one morning, only to crash harder than your weekend plans by lunch? That's the wild world of stock market volatility. And if you're dipping your toes into investing as a beginner or leveling up your intermediate game, understanding it could be the difference between riding the waves or getting wiped out. Picture this, the market's not some steady climb like your grandma's savings account. It's more like a roller coaster designed by caffeinated squirrels. But here's the curiosity kicker. What if I told you that chaos isn't just random noise, but actually your secret weapon for smarter investing? Stick with me, and we'll unpack why markets jitter, how to measure the madness, and what legends like Warren Buffett do to turn it into opportunity. To set the stage, let's talk basics because volatility isn't some mysterious Wall Street voodoo. It's just the measure of how much and how quickly prices swing up and down in the stock market. Think of the stock market as this massive auction house where companies sell shares to raise money, and investors buy them hoping for growth or dividends. Prices fluctuate daily based on supply and demand, but volatility amps that up when changes happen fast and furious. For beginners, it's that gut punch feeling when you check your portfolio and see red arrows everywhere, even if the economy's humming along. Intermediate folks might recognize it as those headline-driven dips that test your strategy. At its core, volatility reflects uncertainty. When everything's predictable, like steady earnings reports or calm global news, prices move smoothly, low volatility. But toss in surprises, like a big earnings miss or geopolitical tension, and boom, prices yo-yo. It's not inherently bad. In fact, low volatility can mean stagnation, where nothing exciting happens for your returns. The key is grasping that the market's like a living organism, reacting to a zillion inputs. For example, imagine you're buying shares in a tech company. One day, a new gadget launch sends the price soaring 10%. The next, a supply chain snag drops at 8%. That's volatility in action, normal but nerve-wracking if you're not prepped. Now, why does this matter for you? As a beginner investor, mistaking volatility for a crash can lead to panic selling at the worst time, locking in losses. Intermediates might chase hot tips during spikes only to get burned on the way down. Understanding it helps you zoom out. Short-term swings are noise, long-term trends are signal. And yeah, while we're looking at these charts that probably look like they're plotting your next bad date, they actually show how prices dance around an average. The goal: build a mindset where volatility feels like a feature, not a bug. Over time, this knowledge turns you from reactive trader to chill strategist, ready for whatever the market throws. Diving deeper, one big piece of the puzzle is what drives volatility in the first place. It's not just luck. There are real triggers that make markets bounce like a bad check. Start with economic data, things like inflation reports, unemployment numbers, or interest rate decisions from central banks. These are like the market's heartbeat. When they beat unexpectedly, prices react sharply. For instance, if a report shows higher than expected inflation, investors worry about rate hikes, which could slow borrowing and growth, so stocks dip fast. Step 1 in spotting this: follow key calendars. Beginners bookmark sites like economic calendars. Intermediates layer in how sectors react. Tech hates rate hikes. Utilities might shrug. Another driver: company-specific news. Earnings calls, product launches, or scandals can swing a single stock wildly, rippling out to the broader market. Take a realistic scenario. You're holding shares in a retail giant. They announce blockbuster holiday sales. Price jumps 15% in a day.